At EY, one tiny question like, is there a better way, may seem a drop in the ocean, but it causes a ripple effect that can spread out to the entire world. Every question we ask can build confidence in the capital markets, can help our clients grow, innovators accelerate, governments solve more complex challenges, and communities to thrive. All of these better questions on a huge scale create long-term value for our people, clients, and society that leads to sustainable, inclusive growth. Every better working answer ladders up to achieve our purpose of building a better working world. So, the question that you ask is the drop that starts the ripple.
Hello everyone, good evening and welcome to the last session of our Sri Lankan tax series. Today we will be completing the topic that was started last week about the value added tax. And today we have the same trainers with us, Roshni and her team. Uh, Shakti is with us, and now I'll hand over to Shakti to continue the session and just give a brief recap to the participants about the last week's session.
Thank you, Feroz.
Shakti, now you can share your screen as well. I have made you the presenter.
Good afternoon and welcome back for the second session on value-added tax in Sri Lanka. So let me do a brief summary of what we discussed in our session 1, and then I will take you all through to the additional topics to be discussed today. So we started to understand the value-added tax in Sri Lanka in 10 points. The first 5 points we discussed in the first session. So those are the very basic and fundamentals to understand the value-added tax in Sri Lanka. The overview of VAT we discussed when it was introduced in 2002. Prior to that, GST was in play, it was in operation. And then the value-added tax, fundamentals of value-added tax, it's on value addition, and it's finally borne by the consumer. There is an input mechanism that operates, allowing each value addition party to charge VAT on their value addition, and ultimately the total VAT on the sale price is borne by the consumer. And then we understood the basic concepts associated with value-added tax. The chargeability is based on this concept. The VAT is chargeable on both on supplies, local supplies, as well as on imports. VAT is on local supply is chargeable only on registered persons. So who is registered person? That based on these concepts that we discussed, that is taxable activity. So you must primarily carry out a taxable activity in Sri Lanka in order for you to be chargeable for VAT. Taxable activity includes carrying on a business. If you carry on a business in Sri Lanka, yes, then that is a point for you to have a taxable activity in Sri Lanka. Then we moved on to understand supply, whether you make a supply in Sri Lanka. If you supply any goods or services, how do we decide whether it's a sale or transfer is supply? So if you provide a service or if you sell your product or goods or goods, then it is a supply. Then we understood taxable supply. Taxable supply means the items that are taxable at 8% or 0% for VAT. The VAT standard rate is 8% or 0%. So if the item is subject to 8% or 0%, other than the specific exempt items, are called taxable supplies. So these taxable supplies, then we understood value of taxable supply. How do you determine the value? So that depends on if it is a local supply of goods, the market value, open market value, it should not be, the consideration should not be less than the open market value. Then we discuss the value at import, that is CIF value added up for 10% markup and additional taxes at import point. So taxable activity, in the course of a taxable activity, if you are supplying goods and services which are taxable and the value of those taxable supplies exceeds the registration threshold, then you will be required to register. That there we discuss the mandatory requirement to register, mandatory registration. Once you exceed the threshold, you are required to register on a mandatory basis. Even if you don't exceed, if you expect or likely to exceed with a reasonable information, then you can proceed to register. That is on a mandatory registration. Of course, now from 2020 onwards, you have an option to register on a voluntary basis. Even if your taxable supplies, the value does not exceed the threshold, you can proceed to register under optional voluntary basis, voluntary registration. So the registration is the key for you to have a VAT liability in Sri Lanka. So the threshold is for the registration. Thereafter, liability, there is no threshold. So any amount of supplies which is taxable, liable to VAT. So the taxable activity, supply of goods or service in Sri Lanka, and then value of taxable supply. So what is important there to exclude the exempt items. If the supply includes exempt, then that will not be counted at taxable supply. So is there a list of items that are taxable item with the rates? No, only the list is available only for exempt. So any supply is liable at 8% unless that list is provided for exempt and zero rated. So if your supply does not fall under that exempt list or zero rated list, then the default rate is 8%. So there is no exclusive list available for 8% items. Then we discussed the upon registrations your obligations, basically the computation of VAT, considering the input mechanism, allowing the input credit. How do you compute the VAT? Once you compute, you pay the taxes on a monthly basis, but the tax returns are required to be filed on a quarterly basis within 20 days. Sorry, within 30 days, because before the month end of the following the month after the end of the quarter, so that you have 30 days from the quarter end to file a return. But to pay the monthly tax payment, you have 20 days from the month end. Right. Then we move, okay, let me go to that straight away to the tax computation. So computation of tax, where we discussed basically on a revenue of 1,250, if the 8% is applied, output VAT is 100. If you have inputs on imports and local purchases, upon registration, you get the eligibility to claim these inputs on imports and local purchases only upon registration. So once you register, you will be receiving, you are required to obtain a tax invoices in support of these local purchases, input VAT. Imports, the CUSTEC is sufficient to support your claim, but for local purchases, you need a tax invoice specific requirement, specifically provided in the VAT law to obtain a tax invoice from suppliers. For them to issue a tax invoice, they should also be registered. Then only they will be charging VAT, and you should also be registered in the VAT. So if you deduct your inputs, thereafter specifically law disallows certain inputs to be disallowed, then you adjust them and arrive at the allowable input 60, and the balance VAT payable is output minus input 40 is VAT payable. But what you need to consider here is the basis we discussed, it's on invoice basis, you have to account for VAT. The taxable supplies does not include any exempt supplies, so only taxable supplies liable for VAT. Input claims should be supported with the valid tax invoice. and it should be claimed within the time limit specified. For imports, 24 months, and local purchases, 12 months. So disallowable input VAT, if any input is disallowed, specifically, then you have to adjust that from your allowable input VAT. So you deduct it from your eligible claim. So that will not be an eligible input VAT. Right. Then the disallowable input VAT include specifically input VAT in relation to motor vehicles used for motor vehicles other than transport vehicles are specifically not allowed. And if you have VAT, input VAT before commencement of taxable VAT liability, that is commencement of taxable supply, you are not allowed to claim input. So if you have any inputs prior to commencement of your taxable supply, you are not allowed to claim input. Then the adjustments, you are allowed to do adjustment for bad debts, tax credit, debit note adjustments. And we discussed finally, there is a limitation on your input claim. Currently it is 100%. Previously, when it was introduced in 2007, it was 85% and subsequently increased to 100%. So 85% of the input were initially allowed and then 100%. But prior to 2007, there were no limitation of input claim. So you can claim any input. If you have excess input, that will result in a refund. So the refund situation is managed by introducing an 85% limitation and later increased to 100%. Right. So by increasing this limit to 100%, so no one can have a VAT refund position. Why? Because your input, you can claim only up to the output. Balance you have to carry forward. But there are three categories of persons specifically allowed to claim excess without this limitation. That is those who are making zero rated supplies and those who are making suspended supplies under SWAT scheme that we'll be discussing today, and the persons registered under section 22(7) registration, a special registration that also we'll be discussing shortly. Those three categories only allowed to claim more than 100% of the input. Right. Once you claim your input, and if you result in a refund, those zero rated or suspended, those who are able to claim more than 100% will result in a refund. That refund will be refunded within 45 days. Theoretically, it's 45 days, but practically it takes years to release the refund. But you are entitled for a refund. So the refund situation arising only in relation to zero rated supplies, mainly for zero rated supplies and RIS, the SWAT scheme suppliers, and 22(7) registration. So who is eligible for zero rated supplies? Who supplies? So that relief only we started discussion. Oh, sorry, we'll have to start discussion today with the reliefs provided under the VAT law. But we have already started discussion on the exemptions last week. So if your supply is exempt, assume this particular supply is exempt, entire supply is exempt, then you will not have a requirement to register for VAT. So the implication is, in this case, if your supply is exempt, your inputs will become a cost to you because you are not able to claim the input VAT. Right. So that we discussed in our last discussion. So let's start the rest of the reliefs in our discussion today. We started the reliefs for exemption. Today we'll be discussing the zero rated supplies. What are the type of implications or the reliefs that you enjoy when your supply is classified as a zero rated, and the special registration called 22(7) registration applicable for new businesses. What are the benefits and the reliefs, and the other benefits under the deferment schemes. We have different deferment schemes in operation on deferment of VAT on imports, deferment of input VAT on local purchases under SWAT scheme currently, It's consolidated under SVAT scheme, all the deferments on local purchases. And the reliefs for special projects identified by the minister or is identified by the parliament as a special project. So that covers basically all the reliefs under the VAT. So let's move on to understand the exemptions we discussed last week. If your supply becomes exempt, the output VAT is exempt, so entire input becomes not claimable. And addition to the supply exempt, I told you if they make an exempt in output supplies, there are corresponding input exemptions are also provided to you manage your input cost. Otherwise, it will not be a benefit. You will not be enjoying a benefit by exempting in certain cases where you have a huge amount of or significant amount of input VAT. If you don't have input VAT, the exempting the output may help you in terms of reducing the price. But if you have a huge input VAT, if you are suffering a huge input VAT and if the output is exempted, then that is not a relief really. So therefore, practically, whenever there is an exemption, there will be a corresponding input exemption also. So that will be mainly at import point, exemptions are available, supply and supply of goods services specifically. If the input is attributable to taxable supply only, you can claim, and if the input is attributable to exempt, it is fully disallowed. And if you have an input attributable to both taxable and input, say for example you are using a building that is attributable to both, you are making supplies taxable and exempt supply, so then you have to identify an appropriate basis to apportion the input that is attributable to exempt and disallow it, and what is attributable to taxable will be allowed. So some of the key exemptions that are there in our VAT law, I have just discussed in our last class. The pharmaceutical products, IT, cellular mobile phones, solar panel modules, educational service, public passenger transportation service, electricity, healthcare services, agricultural products, software developed locally, and IT enabled services. Financial service is also exempt from the beginning, right? There were certain other exemptions granted and subsequently removed. Say, for example, telecommunication services was exempted for a period, limited period from 2011, and then in 2016 the exemption was removed, right? So that's about exemption. So the key point here, the exemption is if you have a mixed supplies with exempt and taxable only, you will have an apportionment. Otherwise, if you have entirely exempt, you don't need to register for VAT. Right. So let's move on to the next relief. The reliefs for VAT under zero rate. If your supply is identified as a zero rate, what would be the implication? So if your taxable supply, say the output VAT 100, if it is a taxable, you collect VAT on 100, 8% on 1,250, and you claim your input. But if the supply is made liable to VAT at 0%, how do you get a relief? Because in this example, 1,250 is your revenue. The 8% VAT is not there. Now it's 0% VAT. So the output VAT becomes 0. It is not exempt, it becomes 0. If the supply is output VAT is 0, the formula for VAT payable is output minus input VAT. So that is applicable only for taxable supplies. If you have an exempt supply, you can't apply this formula output VAT because output VAT is exempt. Therefore, input you cannot claim. But zero rated supplies enables you to claim your input VAT. But at the same time, you don't collect the output VAT. So that's actually gives you a full relief from your output and input, because you are not bearing the VAT cost at all. because you don't collect the VAT on your sales. Whatever the VAT you paid can be claimed as an input. And also, you know, the 100% limitation is also not applicable for zero rated supply. Therefore, entire input can be claimed. So the question is now, in case if you have any inputs that is specifically disallowed, can that be claimed for a zero rated supply? No. If it is specifically disallowed, say for example, motor vehicle, you cannot claim that input. So that will become a cost to you. So in this example, 20 disallowable input VAT. So you can't claim entire 80 as a refund. Although you are at zero rated supplier, you can't claim entire 80 as a refund. So 20 will be disallowed and 60 only allowed to be claimed. And against your output VAT, you have an output VAT 0 because zero rate. Therefore, you will end up with a VAT refund of 60. So if you are exempted, your relief is only on output, and input you will have a cost, but unless the input is also exempted, you don't get the full relief. But zero rated supplies, you get the full relief because your entire input is. So only difference is the disallowable input VAT, you will have a cost, right? So now you know the comparison with the exempt supply and the zero. Exempt, you can't claim the input at all. There is no output VAT. But zero, there is no output, but you can claim the input. But only difference is you have to disallow the specifically disallowed input VAT. So that only will become a cost. So that you can compare with the other reliefs now we are discussing, how this differs when it comes to other reliefs that are provided. Right. So the zero rated supplies, at which point you register, it's also same when you make a taxable supply, commence to make a taxable supply, and once you exceed the registration threshold or likely to exceed on a voluntary basis, you can register. So even if you don't exceed your threshold of 300 million for a year or 75 million for a quarter, you may want to register for VAT if you are making a taxable supply at zero rate. Why? Because you wanted to be in the system, that then only you can claim your input VAT. So that is the reason why I told you, yes, the voluntary VAT registration, there are businesses which they wanted to register on a voluntary because and be in the system. One of the reason is zero rated, right? So the voluntary registration allows any zero rated suppliers to claim their input as a refund, irrespective of the value of supply, whether it exceed or not. The voluntary registration option is granted only from 2020. So that prior to that, if you are required to register mandatory, uh, only the mandatory registration, only upon exceeding the threshold or expected to exceed the threshold only, the registrations was allowed. Okay. So it is from 2020, the voluntary registration is really a relief for those who make zero rated supply. So zero rated supplies are also taxable supplies because the rate is zero. Input you can claim without the 100% limitation that we discussed earlier. But zero rated supplies have an additional conditions imposed from 2021 amendment to the VAT. That is, the most of the almost 99% of the items listed for zero rated supplies requires the payment to be received in foreign currency, and the payment should be remitted to Sri Lanka through a bank in Sri Lanka. Also, a timeline is also specified. The payment should be received within 6 months. If you don't receive the payment within 6 months, the same will not be considered as a zero rated supply. But that's the primary implication. But how do we know that? Because it's going to happen after 6 months time. So at the point, say if you are claiming in January, zero rated, you have time till June to receive the payment. So in case if you receive fine, what you have claimed in January is qualified to be a 60 refund. But in case if within June, before June, if you don't receive the payment, then you disqualify your zero rated position. The question, next question is, am I required to pay the VAT at 8% if I am coming out of the qualifying conditions? If I don't meet the condition, am I coming out of that condition zero rated, then I will fall under the taxable supply or exempt supply. Unless I fall under exempt, then I will be taxable. If I am taxable, then I may have to pay the VAT at 8%. If I pay the VAT, can I claim the input? Yes, but the law has an imposition, a further restriction. If you don't receive the payment within 6 months, or this condition is not met, your input will be automatically, that will also be rejected. So if your input is also will be rejected. So you have a penal provisions in two basis. One is you have to pay on your output. The second imposition is you can't claim your input also, because now you claim any amount irrespective of your output. If you don't receive the payment within 6 months, your input will be disallowed and the output will be subject to 8%. That 8% is a conditional that Commissioner General can decide whether to impose that 8% or not, because otherwise you will be imposed on both. Your inputs anyway will be disallowed. Whether there is an additional 8% to be collected, Commissioner General has the discretion to decide whether to impose a 8% on your supply. Right. So that's the development in 2021 onwards. Previously, we did not have these conditions for zero rated supplies. Only limited to few activities only. This condition was there, but anyway, the time limit was not there prior to 2021. Then the items that falls or qualifies for zero rated, if you see the major items, so the key items that qualifies for zero rated, export of, in terms of goods, all exports are zero rated. Then the rest are in relation to mainly the services. So if you export any goods export is zero rated, because the principle is it's going to be consumed outside. So the consumption tax is only if you consume in Sri Lanka, the consumption tax VAT is applicable on the final consumer. So when it goes out of the country, all your inputs are refunded. So it goes without VAT. When it leaves the country, the product price goes without VAT impact. Then the services. Service exports, services directly connected with international transportation. So international transportation, there is a specific gazette identifies the list of items of services that qualifies. Freight forwarding, all identified specifically services by ports authority, specific services, shipping agent services. So that identifies specific services. Only international transportation gazette, if you identified a service, that will not require a specific additional conditions. So it's there in the gazette if you fulfill the conditions in the gazette. Then the movable, immovable properties outside Sri Lanka, if the services are in connection with properties outside Sri Lanka, entry port trade, if your services are in respect of buying garment office to overseas buyers, garment buying offices in Sri Lanka, if they provide service to overseas parent. Any services, the last one is a common exemption, any services to a person outside Sri Lanka. It can be any service. There is no limitation of in terms of the type of service. So it is any service to a person outside Sri Lanka for the consumption or utilization outside Sri Lanka. So there are two additional obligation, it should be to a person outside Sri Lanka, not to a Sri Lankan person. It should be a person outside. Secondly, it should be consumed or utilized also outside. Then the additional conditions subject to the payments to be received in Sri Lanka through a bank within 6 months. With that additional conditions, yes, any services will qualify if you provide to a person outside Sri Lanka. Right. So basically, export of goods and export of services are broadly exempted subject to these foreign currency conditions. If the item is exempt, earlier also I told you, if the item is exempt, say for example, tea, supply of a tea locally is exempt. If you export the tea, if the exemption, you know the implication of exempt. If the tea is exempt, then those who sell tea, if they have any input VAT on any of their inputs, they are not able to claim the input, so they don't have output VAT. But if it is exported locally, there are all these VATs are embedded in the price. So how do we claim this in? So if you are an exporter, then you have an eligibility because it become a zero rated. Although the item is exempt, if you export it, the zero rate. So the zero rate will prevail over the exemption. So therefore, if the supply is zero rated, even if the item is exempt, you are able to claim your input VAT because it is export and qualifies for zero rate. So you can claim without 100% limitation input, and you will end up with the VAT refund. Right. So the reliefs we discussed now is on right is on the zero rated, the exemption, and zero rated. So the exempt supply and zero rated, the key difference is with the input claim. Right. So the zero rated relief, you get the full relief because output and input relief is both there. But only thing is there is a cash flow problem because you will have to pay this and claim a refund. You have to pay this and claim as a refund. Okay. Let's see what are the other reliefs under the VAT scheme. So the VAT, the both exempt and zero, you have a relief, but the zero rated relief is a full relief. The relief is in terms of input claim that results in a refund. So is there a mechanism to avoid this refund? Since you know that it's going to be refund, since your supply is zero, clearly your supply is zero, is there a mechanism whether you can prevent the payment of VAT on import 60 and local purchase 820 in this example, the total 80? Is there a mechanism to prevent the payment of input VAT so that you don't end up with a refund? Because you know clearly your supply is zero, therefore why should you pay? Because that will be a real relief. If I am not collecting the VAT on the basis zero, then why should I pay the VAT? If I am relieved from the payment, then there is no requirement for a refund. So this principle, on this basis, to give you a relief from your inputs, the VAT law permits a deferment. It's not completely leave you from it. It is not completely leaving you from it is completely leaving you from the payment of VAT, but you don't need to pay the VAT subject to some conditions. So that is deferment until you fulfill the conditions. So the deferment schemes allows subject to the conditions. Say for example, in this case, if I am exporting, so until such time that I export, I am qualifying to be zero rated. Therefore, the input I can defer. If I violate it and if I don't pay, if I don't export it, then I may have to pay the input. So subject to that conditions, the deferment is operating without giving complete relief from the 60 and 20. The law permits a deferment of VAT payment. So you don't need to pay the VAT of 60 and 20 now, you can defer it. So that is a relief, additional relief for those who are entitled for a VAT refund under zero rate. So the deferment eligible for deferment for local purchases as well as imports. So that is an additional relief that we are going to discuss next. Who is entitled for the deferment? So one party is actually those who are eligible for refunds. Those who are eligible for refunds will be entitled for this deferment. So you can defer both the 60 and 20, the local purchase and imports. Right. Let's look at what are the conditions for deferment. So then you can avoid this 60. You can avoid this 60 refund. Then there you have actually an optimum benefit level because you don't pay output, you don't pay input. So you are fully relieved from the VAT. So how that can happen? Let's move on to the other schemes and understand. The reliefs under the new business that is called 22/7 businesses, the registration, 22/7 registration. Generally, I told you, unless you commence your taxable supply, you can't register for VAT. Only upon commencement of taxable supply, either you exceed or likely to exceed, you can register. Before commencement of business, you need a implementation period to put up your factory, right? All your inputs for capital goods, machineries, all the buildings, all inputs. Then what happens? You can't claim because only upon registration only you can claim the input. But this registration 22/7 special registration for new businesses allows you to register even before making a taxable supply. So initially it allows a 30-month period for implementation. If you require, you can extend it with the specific request. So what happens if you request upon your registration, all your taxable supplies, you will not have a supply at all because you have not commenced to make a taxable supply, but you have to register this on a special basis 22/7. If you register, you can claim your input without 100% limitation because there is no output. So there is no 100% limitation. So we discussed the 100% limitation is not applicable for zero rated and the new businesses qualifies for 22/7. Right. The conditions to be met, there are additional conditions because you have to make commence taxable supply within the specified period. Within the specified period, you have to make a taxable supply. That project implementation period and additional period approved by the Commissioner General to make a taxable supply. If you fail to make a taxable supply, then it's a conditional. The registration will be cancelled. Say for example, you do a project of an item, manufacture and sell an item. You have commenced your taxable business. You register for VAT under 22/7. You claim 60 and 20, altogether 80. There are disallowable input VAT that has to be disallowed. The balance 60 as a refund. You claim the refund also. If you have claimed the refund and subsequently if you don't make a taxable supply, say you failed, your project didn't proceed further, then what happens? This is a special registration, then they can reverse your position. Once they reverse, all your input you will have to repay with penalties. You have to repay with penalties all your input. So there is a provision. So that is why it's conditions. You have to make taxable supply. If you don't make taxable supply, you have to repay the benefit with VAT. And there is no timeline. Any time they can claim this 60 refund if you do not make taxable supply. Okay. So this is a third relief available for new businesses. And this relief also end up with refund. This relief is also subject to disallowable input VAT. If you have disallowed, that will be a cost, but entire input is refund. The same way, this refund also can be managed through the deferment scheme. So you are eligible to defer your input under local purchases and on imports. So let's see the deferment schemes applicable on imports and local purchases. So thereby you don't pay this input VAT 80 and the 60 and 20 at the purchase level. You avoid it. How do you avoid it under deferment? Let's look at it. So the deferment on imports, if you have a zero rated supplies without the deferments, you have 60 and 20 input VAT 80. If you have disallowable, assume there is no disallowable, entire 80 is refunded. Entire 80 is refunded. So if you have imports, deferred input VAT, right? If your supply is zero rated, but now with deferments, what happens is second column is with deferment. So you don't 60 entire input 60, you don't pay. You don't have an input VAT. You can defer it at the import point, then you don't pay. Deferment by the deferred at the import by the Commission Director General of Customs, DGC. So if he defer that VAT subject to the conditions, you don't pay the VAT. So in terms of cash flow, you don't incur a VAT cost. So 60 is not paid. So only 20 is paid. So the allowable input VAT is only 20 because 60 is not paid. So the refund is only 20. Because so you can see the deferments allows or permits you to reduce your refund. Okay. So what are the conditions for the deferment? Import deferments are granted by the Director General of Customs subject to the conditions that you have to the purpose. If you are a zero rated supplier, if you are a 22/7, you know that you are qualified for this in addition to the others, right? Then what is the condition? You have to submit the person's eligible categories are imports for manufacture and export. If you import for the purpose of manufacture and export any raw material, then you can defer that VAT because it is for the export purpose. If you are a registered person under 22/7, yes, you will end up with VAT refund. Therefore, you can defer that. Persons registered under SVAT scheme, there is a new inclusion to that deferment scheme other than the rest are from the earlier beginning. The additional inclusion is persons who are registered under SVAT scheme and they are supplying goods, exporting goods or supply services to an exporter. And temporary imports also you can defer VAT on imports. So subject to furnishing of a bank guarantee or treasury bill or corporate guarantee. So there is a limit below, then you can give the bank guarantee or treasury bill, but any limit you can submit a bank corporate guarantee without any in any case. So for the duty value you submit, sorry, input value, VAT value, deferred input VAT value, you submit a corporate guarantee. So the how do you operate the scheme? The deferment scheme is together with the Department of Inland Revenue, the Commissioner General will issue a credit voucher for each import that you defer. The value VAT, the VAT deferred 60, you will obtain a credit voucher from the tax department and submit it to the Director General of Customs. Then he will accept that and defer. So in his records, that is settled by Inland Revenue. So the Inland Revenue will monitor. Thereafter, in any case, if the purpose is not met or anything, they can cancel the credit voucher, and then you will have to go and pay. If you violate any condition, you have to go and pay to the customs together with the penalties the import VAT deferred. That should be payable to the customs, because the department inland revenue may withdraw the credit voucher issue, or they may not issue the credit voucher to clear. Right. So this is the deferment that was there from the beginning, that is allowing you to reduce your impact of VAT refund. So this allows you to, those who are eligible for VAT refunds basically fall into this. So the deferments, sometimes if you are deferment 60, if you end up with a refund more than the 20 in any case, if you end up with a more than 20 a refund, so that means a deferred amount VAT will not be considered as an allowable input VAT. So therefore, it cannot result in a refund. It is not allowable because you have not paid this input VAT. So therefore, there is no refund arising from deferred input. Then we are moving into the reliefs under the VAT deferments called SVAT scheme. So that is applicable before the SVAT. What has happened is actually it's deferment on local purchases. Import is administered by the credit voucher system and then through customs. But the local purchases, initially, the deferment was administered prior to 2011. Prior to 2011, Department of Inland Revenue and the Commissioner General administered this deferment in a very limited scale. Very limited scale, only for persons registered under TQB, Textile Quota Board, and EDB, Export Development Board, with special category, manufacturer category, and value addition. So specifically, a limited deferment on local purchases was administered, and there was a requirement to submit on a quarterly basis a reconciliation of items imported, item exported. So you have to reconcile and submit. That's how the monitoring level was there without looking at the inputs. So the inputs were deferred without a payment. The supplier is also, both are registered under this scheme. So it's a very limited, applicable only to a limited supplies. But from 2011 April onwards, a new scheme introduced that is applicable to all your local purchases. If you are an eligible person for a refund, VAT refund, then you can defer all your VAT on your local purchases. So they have included the previous EDB, TQB, all can, and additionally all the persons who are eligible for VAT refunds, basically those who are eligible for VAT refunds, now they can defer their input VAT, provided they both fall into or register within this scheme called suspended VAT scheme, or SVAT scheme, sorry, a simplified VAT scheme. So it's a simplified VAT scheme where the VAT is suspended, suspended. So it's basically a deferment in the form of a suspension of VAT on your local supplies under simplified VAT scheme. So this SVAT scheme allows you to suspend, the supplier will suspend the VAT on their supplies to eligible persons. So this is a deferment, operates for all the local purchases, supplies within this SVAT registered persons. So there are two types of persons registered. One is the eligible person to purchase. Those who are eligible for VAT refunds are the persons who are eligible to register under this scheme. So those who, zero rated supplies 22/7, and there are other cases also, other persons also eligible for VAT refund. So let's see how they end up with VAT refunds. If they have VAT refunds, then they can, so they will become an eligible persons, and they are eligible to register as a purchaser, RIP, they are identified purchaser. All the others who supplies goods and services to these RIPs are identified as supplier. So these are the two types of registration: RIP, the purchaser registration, supplier registration. Purchaser registration is only for qualified people. RIS, anyone who supplies to RIP is a qualified. Okay, let's move on to understand in detail how this scheme operates, because this is a very interesting scheme, because that allows completely prevent your VAT from, prevent the VAT refunds by deferring your VAT payment through this suspension scheme. So let's see who is eligible to register under this scheme as an RIP. The purchaser without VAT, who can buy the goods and services without paying the VAT on local purchases. Imports, the people who are eligible for deferment. So local purchase, who can defer their purchase VAT. Exporters of goods or services. Section 7 provides that exporters of goods and services. So they, they are qualified to be a zero rated, therefore their supplies are zero, they are eligible for a refund, they are eligible for a purchase, therefore they are eligible to be an RIP. Others, supplies to an exporter. You manufacture and supply to an exporter, indirect export. Indirect export by a manufacturer. You manufacture, you don't export it. If you export, then it's export of goods. You supply to an exporter, then also you are eligible to defer, because otherwise your supplies, because ultimately it goes out of the country as a zero rated supply. Supplies of service to an exporter. Exporter supplies to an exporter, supply of service to an exporter, all three are eligible to be registered under RIP and suspend their VAT on their purchases. The third category, direct suppliers to strategic development projects. So now we understand an additional special project. The next, of course, the next relief we are going to discuss, the relief applicable for these parties. Strategic development projects and those who are engaged in specified projects. So these two relief we have to discuss, because about zero rated export and suppliers of service to export, but this STP and special project we will be discussing shortly. Then the 22(7) registered person, they are eligible to refund. Any persons making 50% or more supplies to the above. Say for example, if I am supplier to an exporter, 100% supplier, then I will suspend my output VAT to exporter without payment of VAT. They will not pay me the VAT. I have suspended the VAT on my purchase, on my sale. The person eligible to VAT refunds, RIP, will purchase, he will now VAT refunds the 140 now, the prior to the SVAT scheme, he has a input VAT on local purchase 100 in this example. He has output VAT 0, right, because he is zero rated and eligible for a refund. So there is no output VAT. So then entire input on 60, imports and local purchase 100 is refund, 180, sorry, 60 plus minus 20 disallowable, 140 is refund. How this SVAT scheme operates? The purchase, say, input on local purchase from a one supplier, he is a supplier to an exporter now. So what happens is, I am an exporter, therefore I am eligible to an RIP. I will purchase from him without paying this 100. How does that happen? I will not pay this 100 to him, because he will be supplying to me on a suspended terms. He will suspend the VAT with a condition. with a condition he will suspend the VAT. So I don't pay this 100 to him. So it's basically a deferment in the form of a suspension. So I don't pay the 100, but I may have to pay later if I violate the condition. So until such time the conditions are fulfilled, I don't need to pay this 100 to him. Then thereby I'm reducing my refund to 40. Earlier I had 140 refund. Now it's only 40. So I am able to reduce my refund through this SWAT scheme where I purchase under suspended terms. Now the problem not actually is not limited at that level, because now the problem is passing to other person. Why? If the supply of 100 is by 10 people, 10, 10, 10 by 10, then all those people become an RIS and they supply to me without VAT. They suspend the VAT. So if they supply under suspended VAT, what's the implication for them? In their returns, what will happen? Let's look at what will happen to them. Suspended supplier, if it is a one supplier, he will also assume that this one supplier, he will have 1,250. He will have a suspended VAT of 100. That 100 only I purchase from him without VAT. So I pay without VAT to him 100 only. Sorry, 100 VAT I am not paying him. He will also otherwise liable to VAT as taxable supply, but he suspended the VAT. Therefore, he has not collected the VAT from me in cash. The 100 worth of VAT he has suspended. Right. So therefore, the problem will be for him now. Why? If he is a 100% supplier to me, he will not have an output VAT because suspended. Now enter input for him, again a problem, he will end up with a refund. So he is end up with a refund of 100, sorry 60. Why? He entirely supplying to me, RIP. Okay. So therefore, he should also be in the system. So the system allows not only to this first category of the 6%, the first 6% eligible clearly. The last one allows everyone, those who have a case like this, 100% supplies to, or more than 50%. Actually, this says more than 50% if you supply to an RIP, you also become an RIP. So that in this example, the RIS, if he is, because he is also suffering now with a refund. Previously, he collected 100 and paid the VAT, but now he does not collect the VAT, 100 suspended. Therefore, he now eligible to a register and a RIP. Therefore, this is, he will also be in the RIP and he can suspend his purchases in return. So the 80 now include 60 and 20 local purchase. The 20 local purchase he can suspend by registering as an RIP. So that is a category, the last category that I have mentioned there as an RIP. So the mechanism, this deferment is also through a credit voucher mechanism. I told you the customs also is through a credit voucher mechanism. This is also a credit voucher. How that operates? RIPs are required to obtain a credit voucher from the Department of Inland Revenue and issue it to the suspended purchases from RIS. So in this example, the RIP purchase it for 100, the suspended, the entire 100 suspended purchases 100, he will be receiving a credit voucher. He will be issuing a credit voucher for this 100 to the RIS. So the RIS will receive a credit voucher for this 100. He will receive a credit voucher. So RIS output is settled by a credit voucher by the RIP. He won't pay a cash VAT, but he will settle through a credit voucher. So this is the same, similar to the import deferment credit voucher. But the obligations are different because it's very complex, practically very strictly monitored. So therefore, RIS will have set of forms to be filed. There is a form number 1 is the application, form number 2 is a suspended tax invoice that should be issued to RIP, suspending the VAT. So he will issue the value of supply and suspended VAT. Then there is a declaration form 4 and 5, SVAT 4 and 5 form numbers. So those are to confirm the RIP purchases. This is only for specified purpose, that is for export, or is it for zero rated supplies? They have to confirm that. So there is a documentation to confirm I am purchasing for this purpose. Based on that only, RIS will, so both party will sign off in a one document and submit it. SVAT 7 is also RIS obligation. All the suspended supplies he will have to submit a schedule. RIP total output he will have to supply an SVAT 3 form, and SVAT 6 all the suspended purchase with the details. So this is very strictly monitored. All these details should be submitted on a monthly basis, in addition to the normal filing obligations. Right. So let's move on to the other scheme. So the SVAT scheme basically allows you to defer your inputs on local purchase under suspended VAT invoices and credit voucher. So you receive a suspended invoice and you settle the VAT through credit voucher. Right. So this is from 2011 onwards. This scheme is in operation to mitigate the VAT refund situation. Let's look at the other reliefs that are available. I told you there are projects qualified for other reliefs, include specified projects and strategic development projects. So if you see the specified projects, though the specified projects are identified by the Minister of Finance. So generally the government projects where the taxes are borne by government, or even foreign funded projects, water project, water board, road project by RDA, Road Development Authority, or power project by CEB. So those projects qualifies for this identified as a specified project, and there are concessions approved in the Ministry of Finance in a letter. So if the project is qualified as a project, the person engaged in special projects, the main supplier or contractor, will be eligible to be a RIP, and that is a person that he will be eligible to claim his input VAT as a, because his supplies, first of all, his supplies to the project will be exempted. So then when he supplies to a government project, the government department will not pay the VAT because it's exempted. If it is exempted, what happens to my imports for the project related goods? If I import, no, there is no exemption for imports. Then I will be, or local purchases, what will happen for local purchase inputs? I will have to pay that. So the contractor who is engaged in special projects will have all the input cost, but output is exempt. So he will not charge on the contract value to the government projects, governments. He will not charge the output. Then the entire input become a cost. But the law specifically permits, if you are supplying to a special project identified by the Ministry of Finance, although your supplies are exempt, you are eligible to claim your input on the basis that the supply is a deemed taxable. So the law makes it deemed taxable and allows your inputs to be claimed on that basis. Right. So that's the same relief is available for strategic development projects, but the difference is strategic development projects are identified by the gazette, because it will have to be initiated by BOI, approved by the cabinet, and finally approved by the parliament, and will be gazetted. So the process is different to identify, but only a significant strategically important projects are identified as strategic development projects. So importation of goods for the project by the project company during the implementation period is exempt. But if you are supplying the goods to these STPs, any supplier, because earlier a special project only identified supplier will be exempted, because the supplier will be identified by the Ministry of Finance, who is supplying the main contractor. But STP does not identify who is the supplier, any supplier. Even if we supply a service to him, this project, we don't need to charge VAT because it's exempt. Any supplier is exempt if the project is identified as STP. Special project only identified supplier. STP, any supplier is exempt. So therefore, this is also a special exemption. General exemption, you can't claim input, but these two special, you can claim the input without this exemption. Right. So although it is exempt, you can claim your inputs. So that's a relief for special projects identified as specified or strategic development. Right. I'm trying to discuss, we have discussed the reliefs. I'm trying to discuss the developments under the VAT Act over the period. Let me quickly have a look at some of your questions and incorporate, or maybe let me answer to those questions. The question whether the question is to whether one person can one person be RIP as well as an RIS, whether the both registration is possible. Yes, the answer is yes, you can register, because you can be an RIP for an export purpose. At the same time, you can supply something locally as well to another RIP. So therefore, you are allowed to be an RIS and RIP both, but it will be an RIP RIS registration. So it will be the both filings should be done under both bases, RIP filing separately and RIS filing. And the other question on SWAT again, the question is whether it is administered through online. Yes, currently, initially it started on a manual process where you submit these credit vouchers also manually, but currently manually credit vouchers should be, but the credit voucher number you can submit electronically, and you can process further without waiting for the manual credit voucher to be received. And other documentation, yes, it's online. Electronically you can submit the schedules, except for the credit voucher. Everything is now administered electronically under SWAT. Right. Let me quickly take you through the developments over the period on VAT, because we have discussed the concepts, the reliefs already. So the key VAT reliefs we have discussed: deferment, zero rated, exemptions, deferments on imports, deferment on local purchases, SWAT, and special projects, specified projects, and strategic development. Now, what has happened over the period? There was development in addition to the normal VAT. In 2003, in Sri Lanka, there was a new VAT is introduced. In addition to the normal VAT, you know that financial services are exempt from the normal VAT. So therefore, there is no VAT on financial services. But in 2003, it was a new VAT on financial services introduced. The computation is different, because there you pay VAT. It's not operating on output input mechanism. So it's deviate from the principles of value addition. It goes to the entirely, it's on profit. Financial, if you are a person providing financial services, the VAT is applicable on your profit. So you pay, it's kind of a direct tax. It operates like a direct tax. So let's quickly have a look at that pattern financial services. Right. Before that, let me take you through other developments and I will discuss briefly on the pattern financial. The withholding VAT by the government agencies. There was a withholding VAT concept in 2007. They introduced an advanced VAT payment by, so your VAT, when you charge the VAT on your supplies to government projects or governments, any government agency, they will withhold 1/3 of the VAT. If it is say 15% VAT, they will deduct 5% VAT and release only the 10% to the payment in cash. So the 5% they will directly pay to the tax department. So that VAT, withholding VAT was introduced in 2007 and subsequently it was abolished in 2011. Then again, optional VAT was introduced. Optional VAT meaning it's a new concept where you don't, there is no input mechanism, only output VAT. If you are below the VAT registration threshold, that time below 3 million or prior to this new threshold, 2007, they introduced this. You have an option to pay a very nominal VAT on, say, 5% VAT or 2% VAT. Initially started with 5%. You pay that VAT directly without an input mechanism. So the benefit is you will be in the VAT system, you pay an VAT. Immediately after, if you are in the borderline to exceed the VAT registration, then you can convert that to a permanent VAT registration. So that relief was given during 2007-12. There is no more optional VAT now. Then thereafter, VAT on trading. Initially, VAT on wholesale retail, only manufacturing and import sale was liable. If you do buying and selling, trading was excluded from the beginning from VAT. So that is from 2002, there is no VAT on trading. But in 2013, they commenced. Initially, those who make more than 500 million for 3 months were made to, they brought to the VAT system. Then subsequently in 2014, those who make more than 250 for 3 months included. 1500 million, 16, 12.5 million, and subsequently now they are all under a normal threshold. So there is no difference for trading. So that is a one development over the period on trading. And then we had VAT deferment on all local purchases from 2011 under SVAT scheme that we discussed earlier. And additionally, there is a piece-based VAT. You pay a per piece VAT instead of 8% VAT. You pay 25 rupees per piece currently. Previously 75, 100. Identified items, certain garment items by BOI companies. When they sell locally, the permitted amount of local sales, then the VAT is collected. When this VAT is collected, there is no other taxes. At import point taxes is also not applicable. Custom duty, cess is not applicable. So it's a special piece-based VAT. It's applicable for, only for specified garments only. Right. So let's look at the financial VAT briefly, quickly. Let me take you all through that. So this is applicable only on supply of financial services in Sri Lanka by any person who is supplying financial services. The registration threshold is separately and is administered. So any person carrying on a business of supplying financial service is required to register if they exceed the registration threshold. So the registration threshold is maintained at 3 million and now subsequently it's maintained at 3 million currently. So it is not increased to 300 million. So 3 million for 1 month or 3-month period, or 12 million for 12 months. The rate of VAT on financial service is 15%. So this is applicable for only on financial services, this 15%, and it is proposed to increase to by 3% from January. But the relevant legislation is not yet passed in Parliament, but budget is passed for an additional 3%. It is proposed as a temporary one-off 3% for tax, temporary measure to increase by 3%. So it's currently 15%, expected to be increased from January, but not yet implemented. So what is the basis? Those who provide financial services, the calculation basis is, I told you, it's on profits. So PBT, profit before tax, and then you have adjustments. What you do is basically you do add the salary and emoluments, the salaries, and accounting depreciation you add, then you claim a economic depreciation similar to a capital allowances. Specified rates are provided for a economic depreciation rates. So you add back the depreciation, book depreciation, and claim an economic depreciation. So that is the basic basis to calculate, and then simply apply the 15% VAT on financial services. So the compliance and under the VAT on financial services includes the VAT payment on a monthly basis within 20 days, within 20 days from the month end. And you have to file an interim estimate for first 6 months, and remaining 6 months a second interim estimate. So these estimates, after that you have to file a final return for the 12-month period within 6 months from the end of the period. So annually you have to file that annual adjustment return on financial service VAT. So this is an additional, but this, although we call VAT on VAT, but if you see the how it operates, there is no input mechanism. Straight away on your profit you pay, similar to a direct tax, but it's charged under VAT law as with the label VAT on financial services. Right. That's all the developments that we have. But what's going to be, what is proposed to be an additional developments in this area is the new proposed special GST tax. Special GST. So that is expected to be implemented. Actually, this was proposed in budget 2021. And it was expected to be implemented from 2021 January, but not implemented. Budget 22 also reintroduced the same to be effective from January this year, but not yet implemented. But the relevant bills are presented, published in January 7, January 20th. It was submitted to Parliament, but not yet progressed further because it was challenged in court, and Court of Appeal issued a determination. So further developments of whether a revised bill is issued or will be issued not yet known. But the key features of this bill that is submitted to Parliament in January, this is applicable only on 5 items: 3 specified goods and 2 specified services. Liquor, cigarette, vehicles, only those 3 goods, and telecom service and betting and gaming services. So who is required to pay? Manufacturers or importers of these goods, service providers of telecom and betting. The rate of tax to be specified by the minister, calculation of tax also to be specified by the minister in a gazette, exemption to be specified by the minister. So all of the key aspects are, the law provides the minister to specify. And the payment also, the payment of tax also is electronically managed, will be managed, and filing returns are all electronically managed by a unit established under the Treasury, under the purview of the Deputy Secretary to Treasury. So it will be a designated officer who will be administering this tax. So it's moving from, actually generally the tax is administered either by the direct Department of Inland Revenue or Customs or Excise Department, but this is going out of that administration current system, and this is expected to be administered under the Ministry of the Treasury directly. So these are the key features, but expected is the VAT on these items also consolidated into this SGST in addition to the industry taxes that they are paying. So once VAT is consolidated, there won't be VAT on this item, but there will be SGST, and the detailed calculation bases are not yet known. The rates are not yet known. So hopefully the rate of tax will incorporate all the industry-based taxes and VAT. Right. So we are now at the end of the 10-point discussion on VAT in Sri Lanka. So we have looked at the basic fundamental concepts, liabilities, special schemes, and the developments over the period, and finally what is expected to come in the near future. Right. Let's discuss any specific questions that you have at this stage. Yes, the REMIS scheme refers to revenue administration and management and information system revenue administration and management information system. It's a electronical platform the department maintains for the tax.
Shakti, you looked at the question and answer box. Are there any more questions?
Yes. No, I think we have responded to the questions during the session itself. I had looked at it. Yeah.
Okay. So if the participants have any more questions, please either you can raise your hand or send it in the chat box.
Can I unmute you for your question? If you can raise your hand. I think Shakil is away from the session. Shakti, can you see the questions? There are two more questions from Sahir and
Yes.
Tanzil. Okay. Shakil, just raise your hand. I'll unmute you when we're done with Tanzil and Shahid, so you can ask the question directly to Shakti.
Yes, the current VAT rate, VAT rate is 8%, and the VAT on financial service rate is 15%. The question on VAT rate, and then the question on have any tax regulations regarding cryptocurrency. What is the impact on tax rates after COVID? Yes, there is no any special reliefs granted in terms of VAT rates or exemptions or the positions what we discuss, except for only relief provided during that period in terms of the delayed VAT payments during the period up to December 2020. There was a relief granted under the Finance Act, not under the VAT law, but under a special Finance Act. Reliefs are provided to waive off the penalties imposed for periods prior to 2020. In addition, there were relief granted for delayed filings because the due dates for filings were deferred during that period. But currently, in addition to that, there are no reliefs in terms of rate or exemptions specifically relating to COVID.
Thank you so
Yes,
much,
one
Shakti,
more.
for your
Yeah,
answers.
yeah.
Is, is there any other question? I don't think there's any other question. I will now invite Harun to formally conclude this series and these sessions of the Sri Lankan tax.
Thank you very much. I hope all of you can hear me. May I also invite Roshni to switch on her camera if she's available. I have to say a few words of praise and also thank EY Sri Lanka officially for for this wonderful series of webinars that have been delivered. So Roshni, if we can request you to join me here. All right, so I think the subject of taxation has always been very central to the capability that ACCA wants to deliver, especially in this part of the world within its members. We always say that when you're looking at a well-rounded accounting and finance expert, taxation is a mandatory element. And as the world is moving forward towards global, businesses emerging or businesses in different parts of the world emerging, and topics like transfer pricing and topics like, distribution of direct versus indirect taxes. Wherever that comes in, automatically we are looking at, professionals like the ones you've delivered these trainings being very well in demand. So I think this content has definitely given a lot of credibility to the content that ACCA was delivering through the 60 Days program. And I'm sure, we've seen the numbers participating in these sessions. We will do the conclusion, become about 200 members, a little short of 200 members every session. So that's the kind of numbers we've been able to touch. But at the same time, there were people from outside the 60 Days program who came in and wanted to attend the session, and therefore we allowed that to happen as well. So I think content-wise, let me say that it could not have been better than what has been delivered. The time was a constraint. The effort put in by the EY Sri Lankan team, marvelous, I must say, and the way Roshni has gathered the entire team, the people with different skill set, people with different specialities around taxation, the way she brought all of them in. I think that's very, very commendable, and we would like to sincerely thank Roshni and the rest of the EY Sri Lankan team for becoming a part of the program, and for helping us deliver this content. It's completely a matter of pride and joy for ACCA members. Roshni, my colleague, I've made special requests. So Nilusha and Ruchira in the Sri Lankan office, they will soon be getting in touch with you with a memoir of these joint sessions that we've delivered. Memoirs to be given to you, and appreciation certificates, etc., to be given to all the participants of these series. So I think with that, let me invite Roshni in to say a few final words before we close the session. And so Roshni, over to you.
Thank you, Harun, as always. Very, very kind words. And as I told you at the beginning, it has been a privilege actually for Ernst & Young to be part of ACCA. And I'm glad that we have been able to contribute towards, the continuous education of your members. And I hope it did go well, because as I told you, this is the first time that we've sort of done a sort of structured program. Please do let us know if you have any sort of recommendations. We are happy to sort of, make changes as and when, because as you said, tax is revolving, and, so many other changes are happening around the world as well in terms of tax. And I'm glad that ACC has taken a step to actually to educate members, because this is an area that, as I told you, people really don't venture into, because they always feel it's difficult. And, also I'm so glad to see that you all have sort of, embarked on having continuous education on tax, and I'm really, really happy that we have been able to sort of be part of it. And I also want to place on record my sincere appreciation to the Ernst & Young tax team. If without them, I don't think I would have been able to sort of, conclude this, because they have really rallied around and also done, a lot of work and also commitment, because it's actually pretty late in the night as well. So I just want to thank everyone. I've been doing that from the time we started. So thank you to everyone. And thank you again, Harun, for inviting us. And hopefully we will sort of, have more collaboration in this area as well. So all the best to the members and to ACCA. Thank you. Have a good evening.
Thank you very much. Thank you. And final words from my side. From tomorrow onwards, we will be embarking upon taxation for Pakistan. And we have partnered with Ernst & Young in Pakistan now, who are going to deliver the next few sessions on PK tax, after which we will jump on to Bangladesh tax. So that's something that's that's part of the plan. You will receive an invite for tomorrow's session, for sessions from tomorrow onwards. So please look out for your emails, for an invitation for the rest of the sessions. And Roshni, talking about future sessions, we'll definitely be working very closely with you. I've already discussed with Nilusha that this is going to be a regular annual feature of taxation between ACC and Sri Lanka. I mean, these trainings, and any developments, any improvements, any updates as and when they come, we will be sharing that content together with ACCA members and going forward for the wider accounting community as well. So thank you very much for everyone for your participation, for listening to the content. I'm sure you would have found it useful, and I'm sure in your discussions with your colleagues, your peers, you will now have an upper edge, because of all this taxation content from Sri Lanka under your belt. So with that, I wish all of you good luck. Thank you very much, and looking forward to seeing you tomorrow with a new aspect of taxation, a new complexity of taxation, rather to say, which is about Pakistan. So thank you very much, and take good care of yourself. I would also want to mention one final individual, Feroz, who has been very, very regular and very sort of prepared to help support not just the trainers but also the participants of the 6 Minutes program. So thank you very much, Feroz, for all your efforts as well.
Yes, thank you. I forgot to mention Firoz as well. Thank you so much. He's been very patiently teaching everyone how to use the system. So thank you again.
All right. Thank you very much, and take good care of yourselves.
Yes, thank you. Good evening. Yeah.